Recently, the Kenya Revenue Authority (KRA) announced plans that will allow importers of second-hand cars to defer paying taxes for up to 1 year. This move will help boost importers' cash flow positions and lower automobile prices. As an importer, it is important to understand what tax deferment entails, its implications, and what you can do to ensure proper tax planning. This video will take you through these 3 areas. To begin with, deferred taxes refer to taxes recognized in the entity's balance sheet but payable at a future period. This means that deferred tax liability is created when a tax obligation is accumulated in one financial year but is due in the subsequent year. Please note that differences between the book profit and taxable profit can be attributed to timing difference. Therefore, deferred tax liability arises due to the difference in timing between when the tax was accrued and when it is due to be paid. The main benefit of deferring taxes is that doing so helps improve an entity's cash flows, increasing its purchasing power while lowering the cost of selling imported goods. Despite tax deferment being a good thing for importers, it also has some shortcomings. First, the economic uncertainty can impact projections of future taxable profits that are used to assess the recoverability of deferred tax assets. This means that if external events trigger economic uncertainty, then a company's projections of future taxable profits can be affected by several factors. Such factors include changes in forecast cash flows, changes in a company's tax strategies, major enacted changes to the income tax laws introduced by the government, and changes in a company's plans to repatriate or distribute profits of a subsidiary. The second shortcoming associated with deferring taxes is that it can be challenging for importers to understand the different complex cross-border tax rules and regulations. This is especially for importers operating in various jurisdictions with different tax laws, thus affecting deferred tax reporting. Third, tax deferment is associated with the creation of deferred tax assets and liabilities due to timing differences between the recognition of revenue for accounting and tax purposes. The deferred tax assets and liabilities affect cash flow projections. Given these implications, there are a few measures you can take as an importer to plan your taxes better and ensure consistent cash flows. 1. Consider how uncertain economic conditions could affect your company's tax strategies and plans. 2. Assess whether there is any uncertainty about income tax treatments. 3. Determine whether there is an enacted change in the income tax law. If there is, then it may impact the recognition and measurement of deferred tax assets. 4. Determine whether there is a plan to repatriate or distribute one of your subsidiaries' profits, because this would trigger recognition of a deferred tax liability. 5. Update projections for the reversal of taxable temporary differences and for other future taxable profits. Lastly, provide clear and transparent disclosure about judgments and estimates made in recognizing and measuring deferred tax assets and liabilities. I trust that this analysis will help you in planning for your deferred taxes and reporting. I understand that some of the concepts discussed here are a bit technical and industry jargon is involved, therefore, feel free to send your queries through the comments section. Thank you for watching.